All right, so welcome back to Minzo Pass. This is part 2 of our live webinar. So welcome back. We have 3 special people here. We have Miss Astor from Washington, D.C. We have Rebecca from Nevada. And we have Layla from Maryland. So yeah, what everybody has in common is everybody wants to pass the insurance exam. And watch these faces. In the next few weeks, all of them will come back on and give their testimonial how this was able to help them pass the exam. So part 1, we cover with the introduction, all of that, different types of test questions. That's good. But as I said in part 1, in order to pass your exam, you need to do well at both things, right? You need to know the test taking strategies, right? Like time management, all of those things, the different types of questions, how to answer them, all those things, get enough sleep. So that's test taking strategy. But you can know all the strategies, but if you don't know the exam content, you're not going to pass either, right? So to be successful, you have to do both. Most exam providers focus just on the content, don't focus so much. They don't do any strategies. We do both. All right. So let's go into let's go into some exam content. Now, the good thing is for you guys, this is a very small group, which works to your advantage. So what we're going to do is we're going to talk about a part of the exam that's very difficult for most people. We're going to start that today, and then, of course, we're not going to finish, and then we can continue tomorrow. That is taxes and retirement. So anything that has to do with taxes, on average, tends to be very difficult. It's very complicated, and the retirement plans. So we're going to talk about that here. So I'll go ahead and share my screen. What we like to do is we like to use our active learning strategy. What that means is that we don't start with explanation, we start with questions, right? Yeah, you're going to get them wrong. That's okay. But when you do the questions, and you attempt them, even if you fail them, right? But when I come and explain it, it makes more sense and it sticks more. Instead of me just coming and explaining, that's the traditional way of learning. Your teacher or trainer will come and teach, and then you have tests at the end, right? But what we do is test first, training, and then test. So you see where you were before and where you are after, progress. And then that also active learning, that actually triggers your brain cells, because when you get the questions wrong, it causes a little discomfort in your brain. And usually when there's discomfort, that's why most of the time when something traumatic happens to you, you tend to remember it a lot longer, sometimes for the rest of your life, than just ending the area. So it's that same approach, but just mild discomfort. So your brain gets a little worked up, and then when we come and explain it, it's like a glue, boom, it just sticks. That's the active learning strategy. When you take our course, we have a whole resource like articles, YouTube videos that actually backs up this, that it actually works. And that's one of the reasons we have such a high pass rate of 82%, almost double the national average. All right. So, but before we can start, any questions, comments, concerns before we can start?
Nope.
All right. And I'm having there's a hot tea with aloe vera roots, lemon, ginger, honey, mixing up something to warm up my throat, because when I talk too much, then my throat gets dry. Hello. All right. Well,
Okay.
your mom is trying to get her life insurance license, making to get you more toys.
Mhm. Pretty.
All right. So,
I have more question.
go ahead.
I have a class right now to start maybe like a 6. Are
Hmm?
you gonna share with us, about tax and other? Are you gonna teach anything today?
Yes, and that's what we're about to do right now. So,
Okay.
again, because today is the first day, we didn't really go into a lot of content, but tomorrow we're going to do this tomorrow also. So hello, ladies. So yeah, so tomorrow we'll cover. Yeah, we're going to cover more tomorrow. Yeah, but we're going to be finishing at 6 o'clock.
Okay.
Yeah. All right. So let's go ahead here. Let's talk about the first thing here. Let me share your state exam outline, right? So for Nevada, for Nevada, right here, right? So what we're going to do is, we're going to talk about retirement and other insurance concepts, right? So we want to start with third-party ownership. If you look here, this is the same thing here for Washington, D.C., right? Why does this thing keep? Yeah, it's the same thing for Washington, D.C., right? Now, third-party ownership, life settlements, group life insurance, we're going to cover all of that. So let's go ahead and get started with third-party ownership. What I want to do is I'm going to, first of all, have you guys answer the question. Again, it's just one question, but to just see what you understand about it, then I'll go ahead and explain, and then it will go on. All right. So this right here is the first question. So now I'll give everybody, just 2 or 3 minutes. Read this, and then you can write down your answer. Tell me what the answer is. Let's give 2 minutes. Okay. So Miss Astor selected B. What's your answer, Rebecca?
I would say B as well.
Okay, so B, both of you. Leila, are you there?
Yeah, I will say B as well.
B. All right. So let's see who is right. Correct answer is C. So let's talk about third-party ownership, because this is on your exam outline. Again, if it's on your exam outline, that means that more than likely it's going to come on your exam, right? So you got to know all those topics that are on the exam outline. All right. So let's talk about third-party ownership. What does it mean when it says third party? We know third party usually means someone else, right? No, a third party, right? So a third person. Most of the time, the parties will most of the time be two, right? So if you have a third person or third organization or whatever, that's called a third party, someone else. So in insurance, and I hope everybody has their pen and paper notes, because I'm going to cover a lot of things. Because how we do our study is, once you understand a concept, right, and we say core concepts, once you understand that concept very well, then it doesn't matter how the question is worded, because they're not going to bring the same exact question word for word, but they're going to ask you a question on third party, right? So if you understand what third party means, no matter how they ask that question, you're going to get it right, right? So we're going to we're going to cover everything that has to do with third party. So that's one topic, you know, that if it comes on your exam, you're going to be able to get right. So first of all, let's start with some definitions. Because they're not going to ask you who is an insured, what is insurable interest, who is a policy owner, none of that, right? But they expect you to know. So let's start with some definitions. Number one, and you can write this down. Insurance contracts, right? The parties, very important. The parties to an insurance contract are the policy owner and the insurance company, not the insured. On your exam, they're going to trick you. They're going to say, which of the following is a party to an insurance contract? Insured, insured, insurer, policy owner, then D, policy owner, and insurer. Correct answer will be policy owner and insurer. So the parties to an insurance contract are the policy owner and the policy holder. Another name for policy owner is policy holder. It all means the same thing, right? Those are synonyms. Policy owner is policy holder. Who is the policy owner? The policy owner is the person who owns the policy, right? They have all of the ownership rights, right? They have all the ownership rights. They can cancel that life insurance policy. They have they have the right to pay premiums. They have the right to take out loans from that policy. They have the right to add someone to the policy. They have the right to name a beneficiary. They have the right to transfer ownership, to sell their policy. The policy owner or policy holder is the person who owns that policy. Policy owner. You own that policy. Policy holder, who holds that policy? You. So that's who the policy holder is. Now, most of the time, the applicant is the same as the policy owner, because the applicant is someone who applies for life insurance. So let's take Rebecca. Rebecca applies for a life insurance policy. So she's the applicant. But when that application is approved, then she goes from being an applicant now to a policy holder. All right. So most of the time, the applicant is the same as the policy holder. Now, let's get to the insurer. On the exam, they're going to say insurer. Let me annotate here so you guys can see. So we're just going to come here and just do some quick definitions, because if you don't understand these definitions, you're probably going to end up getting the question right. Okay, so insurer, right? Insurer. So on your exam, you're going to see insurer. I-N-S-U-R-E-R. Just know that insurer just means insurance company. Okay. This will take forever to write. Insurer just means insurance company. Most of the time on the exam, they're not going to use the word insurance company. They're going to say insurer. So you just have to know insurer means insurance company. Other thing on the exam, they're going to have the word insured. I-N-S-U-R-E-D. Geez, my handwriting is terrible. Insured. Insured. So the insurer is the company that's selling the insurance company, right? And as I said, the contract is between the policy owner, right, and the insurance company, not the insured. Now, most of the time, the insured is the same as the policy owner. Now, who is the insured? The insured is the person whose life the application is based on, because this is life insurance, right? So it has to be based on a life, right? That's why it says life insurance. You have property insurance, it's insurance on a property, right? So the property insurance has to insure a property, 425 Main Street. It can be a property. right? So life insurance, they have to insure a life, right? And the insured is the person whose life is being insured. It's the person who has to die before death benefits are paid off. It is the person whose life is taken into consideration to determine the premium and whether the application will be approved or not. So that is the insured. Now, most of the time, over 90% of the time, the insured, the person whose life is covered by the insurance company, is the same as the person who is applying for the policy. For example, I have life insurance, right? But I apply for that life insurance on my own life. So I'm the applicant and I'm the insured. So God forbid, if I die, my family gets the death benefit, right? So I'm both the insured and I'm the applicant and the policy owner. Now, let's get back. Insurance contracts are contracts between the insured, the insurer, right? If it's an ER, that means it's the insurance company. If it's an ED, that means the person whose life has been covered, right? So insurance contracts are between the policy holder and the insurer. The insured has no rights. The insured has no rights. They're just there to put you down to base the application on your life. But once that application is approved, that is it. Now, on your exam, it gets confusing. Most of the time, they're going to use insured instead of policy owner. And we're going to go through some of those questions. And you'll be like, hold on, but they should be the policy owner. The reason they do that, they're making an assumption because most of the time, life insurance, the policy owner is the same as the insured, right? So a wife gets insurance on her own life and makes her husband the beneficiary, right? Someone gets insurance on themselves, make themselves the beneficiary. They are the insured, and it makes someone else the beneficiary. So it is different. But the contract is between the policy owner and the insurance company, not the insured. The insured has no right. Once that application is approved, other thing to remember is once that application is approved, the insured can never be changed. You can change your beneficiary, but you cannot change the insured. Once that policy is enforced, you cannot change the benefit. You cannot change the insured. So another thing that everybody else in that contract, the beneficiary can be changed. You can sell your life insurance to someone else, and we'll talk about that in the next topic called settlements, life settlements. So the policy owner can be changed. You can transfer ownership to someone. Like, let's say you have a life insurance policy, you can transfer ownership to your kids, right? So you can transfer ownership to someone. So the owner of the life insurance policy can change, the beneficiary of the life insurance policy can change, but the insured cannot change. The insured remains in place for the duration of that policy. Now, why does it say third party? So now third party comes in place when the insured is not the same as the policy owner, or if the insured is not the same as the applicant. So let's take, for example, Layla. Layla goes and applies for insurance on her kid's life, right? Because she is not getting that insurance on her own life, that's considered third-party ownership. Third-party ownership, it just means that someone other than the insured owns that policy. That is what the third-party ownership is. So now, what are some examples of third-party ownership? The first example is of a third-party ownership. It's a juvenile policy. You can write this down, juvenile policies, because they may ask, which one of the following is an example of a third-party ownership? Juvenile policies, key person insurance, all of that. So Juvenile policy. Juvenile, on your exam, they're not going to use the term minor, but we know minor is someone under the age of 18, right? So they're not going to use minor. They're going to use instead juvenile. So just know that juvenile is someone under the age of 18. So juvenile policies are third-party policies. Why? Because you as the parent getting insurance on your kid's life, you are not the insured, your kid is the insured, and you own it. So the insured is different from the policy owner. So that's considered a third party. So juvenile policies is one example. Number two, second example is business insurance. Business insurance. What are the types of business insurance? We have key person insurance. That's another type of third-party insurance. What is key person? Again, we're going to talk about that in other topics. But key person insurance is where the business gets life insurance on their employees, right? So let's say Rebecca has a business, right? And let's say it's called Rebecca Incorporated. And now she goes and gets life insurance. The business gets life insurance on her employees because the owner of the life insurance is not the same as the person who is insured. That is called third party, right? Business getting insurance on their employees is called key person insurance. So that's another example of third party ownership. The third example of third party ownership is executive bonus plan. Executive bonus plan. You can write this down. Again, that's a business use of life insurance, but it's called executive bonus plan. So executive bonus plan, again, the business buys life insurance, right? The business is the the business buys life insurance on the business gets life insurance for their employee. The business pays the premium, but that employee is the that employee is the insured, right? And that employee, executive bonus plan would not be an example. Let me just confirm that. Just hold on 1 minute here. I don't want to tell you the wrong thing here. Let me just confirm here. So key person insurance is one. So scratch out executive bonus plan. We'll get into that. Executive bonus plan is where the business will pay the insurance premium for their employee, and that employee is both the owner and the insurer. So that does not count. But key person counts, right? So those are two common examples: key person insurance and juvenile policies. I'll stop here. Any questions? Because we'll cover more on third-party insurance. Any questions? Questions, comments? All right.
So person would not be a husband getting a policy on wife or vice versa.
Yes, a third party will also be a spouse, right? So a spouse getting insurance on their partner, right? That is also considered third party, or a child getting insurance on your parent, right? So I'm the applicant, I'm the owner, but I apply and get insurance on my mother or my father, right? So anytime the policy owner and the insured are not the same, is considered third party ownership. So examples of that would be a wife that purchased a policy, on the husband's life, or it can be vows. It can be the opposite. A parent purchasing insurance on their child's life, or the child purchasing insurance on their parent's life, or company purchasing insurance on their key employees. Or another thing is also buy-sell agreements, right? So how that works is business partners, it's called cross-purchase plan. We're going to get into that. But business partners will purchase life insurance on each other. So let's say Miss Astor is my business partner, and I say, okay, I'm going to purchase life insurance on you, you purchase life insurance on me. So God forbid, if either one of us die, the life insurance will be enough to buy out, your equity and the business continue, right? So those are all examples of third-party ownership. So parent and child, spouses, key person insurance, and cross-purchase plans. Any questions?
No.
So now, very important, and let's come back here to this question because this is what this question asks, right? So let's come back here to this question. So it says here, third-party ownership provides that policy owners who are named as beneficiaries must have what?
Insurable interest.
The key is, first of all, what is insurable interest? Another important thing is on your exam outline, so you have to know it. Insurable interest just means that you stand to lose something, right? You as the policy owner, right? You stand to lose something if the insured dies, right? And you stand to lose something either emotionally or financially. So let's just say a parent and a child, right? Does the parent have insurable interest in your child? Yes, because no parent wants to see their child die, right? So if I'm a parent and God forbid my child dies, I'm going to suffer something. I'm going to suffer emotionally, maybe not financially, but definitely will suffer emotionally, right? So I have an insurable interest in that person. Or let's say if I'm a business partner and my business partner dies, I have an insurable interest in that person, right? Because if that person dies, I'm going to suffer financially, right? Our business will suffer financially. So I have an insurable interest in that person. And we're going to talk about insurable interest in another topic, but I'll just touch on this a little bit more. Insurable interest, another thing to remember is it has to exist at the time of application. Okay, so the most correct answer is insurable interest has to exist at the time of application. Why does insurable interest have to exist? Well, insurable interest has to exist because they don't want, I'll keep everything real, right? We know that people kill people for life insurance all the time. I mean, that is just a fact, right? You can watch true crime TV and all of that. No, it's serious. No, husbands killing wives, wives killing husbands, parents killing, children killing parents for life insurance, right? So what the insurance company came up with is that in order for you to get life insurance on someone, you have to prove to them that you have some kind of interest in that person being alive. That's why you don't get insurance on a complete stranger, right? Because you have no insurable interest in that person dying, and what used to happen is people used to get insurance on people and just kill them and walk away with the death benefit, right? So anytime you're getting insurance on someone else, right, other than yourself, you have to prove that you have an insurable interest in that person. Insurable interest is you showing that if that person were to die, right, or become harmed, you suffer emotionally or financially. I'll stop here and take any questions.
No.
Any questions?
No.
Okay. So we know that third-party ownership provides that policy holders, policy owners, anytime, again, when there's a third-party ownership, you must prove insurable interest, right? So policy owners who are named as beneficiaries must have insurable interest in a proposed insurer. Now, just a little caveat for this question. Beneficiaries do not need to have insurable interest in the insured, right? So Mindy, I'm sorry, I keep calling me, Rebecca.
That's my first name, so it's okay. I go by my middle name.
So Rebecca could say, you know what, I want my beneficiary to be, for my life insurance policy, I want my beneficiary to be let's say, the boys, the Boys and Girls Club of America. They don't know you from anywhere, right? They probably don't know your name, right? But you can pick them to be a beneficiary. Your beneficiary doesn't necessarily have to be a human being. It can be a non-profit. Sometimes people make their churches, they can make their school, where they graduated from, all of that to be. So you don't need to prove, the beneficiary doesn't need to prove insurable interest. But the policy owner, when you're applying for life insurance on someone else, you have to prove insurable interest. And the most correct answer on your exam would be at the time of application. If at the time of application is not part of the answer choices, then the next best answer would be at policy inception. Okay, but at the time of application is the most correct answer. So that's insurable interest. Any questions?
Yeah.
No questions? Okay. So in third-party ownerships, designated primary beneficiaries who are also policy owners. So if you're also the policy owner, must have an insurable interest in the proposed insured. All right. So let's do a little feedback here to make sure everybody got this. Miss Astor, tell me everything you know about third-party ownership.
So,
Look at your notes. That's fine too. You can look at your notes.
yeah, the third party insurance means under me, who you have the first one is me, the second one it can be my kid or my husband
Mhm.
who insure under me. That means I think so.
Mhm.
That's correct?
Yeah, that's correct. So third party, the key thing is, even if you don't remember all the examples, just remember that anytime the applicant or the policy owner is different from the insured, that's third party ownership. And what are the examples of that? Well, husband and wife,
Yeah.
husband insurance on the wife getting insurance on the husband, or parent getting insurance on child getting insurance on parents, or business partners, or business getting insurance on their employees. All of those, what they have in common is, the applicant is different from the person who is insured. So that's third party. All right. Rebecca, tell me everything you know about third party ownership.
Third party ownership is having an insurable interest, meaning there has to be some sort of loss if that person is no longer with us, whether that be emotional or monetarily. And it also is insuring a third party, which we go back to. It could be partners, it could be business partners, it could be child to parent, parent to child. And yeah, that's what I can remember for it.
Okay. But key in who must have insurable interest or prove insurable interest?
Applicant with the
Perfect.
at the time of application.
Okay, that is good. All right. So now we're still on third party ownership here, right? So let's Miss Astor, who are the parties to an insurance contract?
Say again.
Who are the parties to an insurance contract?
The insurable.
No, okay.
Contract. The contract is the police owner.
Mm-hmm.
So, and the third party, the insurable, or no?
So I'm asking who are the parties to an insurance contract? So you like, who is the contract for insurance between the contract for insurance? Now who is legally a part of that contract?
The insurable and police owner.
Yeah, the insurer, right? ER.
Yeah, insurer.
Company, right?
Yeah, insurer. Yeah.
The insurer, and what's another name for insurer?
Insured, insurer and insurable.
No, no,
Insurer,
no. What's another name for insurer? Like, what's another name for insurer? With an ER.
the
It's-
the insurance company,
Perfect, perfect. So
Yeah.
another name for insurance company is insurer. So, but on your exam, they're not going to use insurance company. Most of the time, they're going to use insurer. But people get insurer, ER, confused with insured, ED, right? You know,
Yeah.
two different. But the contract for insurance is between the the insurer, ER, insurance company, and
Insurer.
policy owner. Okay, so those are the two. All right, so let's ask a few questions here. Rebecca, this is for you, right? So a parent buying a life insurance policy on a child, right? The parent is the policy holder. Which insurance agreement below will be appropriate? Third-party ownership, family term rider, buy-sell agreement, irrevocable beneficiary.
Okay.
Okay, third-party ownership, right? All right, and let's get here to Miss Leila. What is true about third-party ownership of a life insurance policy? A, it is widely used in estate planning for business uses and for minors. It is illegal in most states. That's B. C, policy can never be assigned after it is issued. D, beneficiary is required to be revocable. So what is true about third-party ownership of a life insurance policy? If you want, I can repeat the question, or
She's on mute.
oh, she's on mute. Okay.
Sorry.
Mhm.
Yeah, I think the minor, you say the minor, juvenile, and the business owner.
Perfect.
That's
Perfect.
it.
Here's the correct answer. All right. So that's it. Before we move on, anyone has any other questions on third-party ownership? Because now with this, if you understand it very well, if they ask you any question on third-party ownership, you should be able to get it right. So now we're going to go to our next topic, which will be our last for the day. Yeah. And that is life settlements. Right? So let's take 2 minutes. You guys can answer this, and you can text, put in the group chat what your answer is. You got 1 more minute.
Is it?
Okay.
Hold on. I did mistake.
All right. So both of you selected C, right? And C is the correct answer, right? So correct answer is C. So let's talk
High
about, huh?
High
Huh?
five.
Oh, half. So both, all of you selected C, right? Which is the correct answer. So let's talk about life settlements. So one of the benefits of having life insurance that a lot of people don't know about is you can actually sell your life insurance and walk away with some cash, right? So, so you have 2 different types of life settlements. You have one I just called the regular life settlement, And then you have one that's called or viatical settlement. Viatical settlement. Right here, you need to know this. You just need to know the difference. So right here, viatical settlement. Okay, so we have life settlement and viatical settlement. So now, so let's start with the similarities, right? So when you have a life insurance policy, you have the right as the policy owner, you have the right to sell that life insurance policy. So let's say I have $1 million life insurance policy, and I'm the owner of that life insurance policy. I can sell it to a company, right? And that company will give me maybe $500,000, right? Hey, I'm selling it for $500,000. I am excited, man. I just got $500,000 cash. Now, when I die, God forbid, I'm going to live until age 95, like my late grandmother. But so God forbid I die. Now that it could be a viatical settlement, provider or life settlement provider. Now they just cash in, right? So now they bought that policy for $500,000 for me, but it's worth $1 million. But when I die, I'm insured. Now they cash out, $1 million. So now they just got what, $500,000, in profits, right? So the key difference, the similarity is both of them, life settlement and viatical settlement, they are sold to a third party, right? For less than the face value. On your exam, they may use face value, they may use death benefit, they may use policy proceeds, but they all mean the same thing. Death benefit is the same as face value. Why I say face value? Because most of the time, for most policies, well, this was back in the day, but some companies still do it. Your death benefit will be on the first page of the policy, right? So that's why it's commonly referred to as face, it's referred to as face amount, right? Or the face value. So just know face value is the same as death benefit, and death benefit is the same as policy proceeds, right? PROCEEDS. And then another name for that too is also called limit of liability, because that is up to the maximum the insurance company will pay. So limit of liability. So I have students come and tell me, yeah, I saw something about limit of liability on the exam about something. I have no idea what that was. If they said death benefit, you have known, but they just switch up the terminology. They use limit of liability and throw you up. So on your exam, you want to know all these all these synonyms, right? So that is the difference. Now that is the similarity. Now let's talk about the difference. For life settlement, you can sell it at any time. You don't need to be sick, nothing. You can sell it to a life settlement provider, right? And it got a lot of these companies, sometimes they advertise on TV, and you may be wondering, but why would someone want to sell their life insurance policy? Well, sometimes, well, you know what, I can't afford to continue paying premiums, and so I'll sell it, and that life settlement provider, they will take over the premium payment. They will become the new owner. They will be the beneficiary. They will take over premium payment. So they will take over the premium payment. Hey, and I walk away with cash. I get 200, even if I get $100,000 cash, you can have the 1 million. I don't care, right? So that's life settlement. Life settlement, you don't have to be sick to sell your life insurance. For viatical settlement, you have to be terminally ill to sell your life insurance policy. So that is the main difference between the two. Life settlement, you can sell it at any time. You don't have to be sick. Viatical settlement, you have to sell it only if you're terminally ill. What is the definition of terminal illness? And and this is where your state law comes into place. And if you take our course, it will be specific to your state law. So some state laws will say terminal illness is any disease or medical condition that could, that could result in your death within 12 months. But the broader definition is actually 24 months. So again, it depends on your state. It could be either 12 months or it could be 24 months. But either way, you're going to die within a certain period of time. You have a licensed medical provider tells you, hey, you have this medical condition, and because of it, you're going to die within 12 months or within the next 24 months. That's considered terminal illness. So if you got that terminal illness, then the law allows you to sell your life insurance policy to a vital settlement provider, right? So if it's a vital settlement, then the buyer will be a vital settlement provider. If it's a life settlement, the buyer will be a life settlement buyer. So you can sell your life insurance policy and walk away with cash. Why is it like that? Because most people who have terminal illness, they have a lot of medical bills, right? I know one of my clients, her husband had a terminal illness, may his soul rest in peace. He passed away last year, but medical bills, they had to come up, they had to take a home equity line of credit because the wife could not work anymore. And then the husband, of course, he's terminally ill, so that's loss of income, but he still got to take care of the kids and everything. So it was hard, right? So when you have stuff like that, the government says, okay, you know what? We can allow you to access some of, we can allow you to enjoy your life, your life insurance death benefit while you're still alive. So that is vital settlement. And we're going to talk about that in another topic in detail, but that is the difference. Any questions? Any questions, comments?
No.
No questions? All right.
Maybe is there a for the life settlement, is there a particular amount that it must be sold at, or it could be for any amount?
Good. And it can be for any amount, but it has to be less than the death benefit. So it just depends on, it depends on what you and the life settlement provider can come up with, right? If they can sell you your 1 million, if they can buy your 1 million policy for 500,000, hey, that's a lot of money, right? But it's always less than the face amount, because think about it, they have to cash in, so they're not going to pay the same amount like the death benefit. And most states, again, this is where your state law, when you take our course, it'll be different from state to state. Most states will require, in order to have, to engage in a vital settlement, you have to have had that policy for at least, some states will say at least 1 year, some states will say at least 2 years, but you must have had that policy for a certain period of time.
And if you're
Uh-huh.
selling it to someone, so like, let's say I have my policy and I want to sell it to you because I can no longer pay the premiums, and it's at 500,000. If I want to sell it to you for 400,000, can I do that?
Yeah, again, it's a contract between you and me, right? So whatever we agree to, but it will be a written agreement, everything, signed, notarized, everything, and then you send it to insurance company. They would take time to do their own investigation, but if both parties agree, the insurance company very rarely will say no. So they'll just transfer ownership over.
Okay.
Yeah. And then that provider, they will take over the premium payment, right? Because they will be the new owners now, right? So life insurance, that's why life insurance, unlike other types of insurance policy, life insurance are considered value contracts, not personal contracts. Your car insurance is a personal contract. Your home insurance is a personal contract because it cannot be transferred. But life insurance is a value contract because it can be transferred, right? But again, I don't want to get too ahead of. But on your exam, they're going to say all of the following are characteristics of life insurance except, and they're going to have, you know, personal contract. No, it is not. But that is the difference.
Got it.
Any questions? So let me take a few more questions here on life settlements, and then I'll just ask you guys a few questions, and let's see here. Let's see. That's not what I want. All right, so this question goes to you, Leila. Okay. Tell me everything you know about a life settlement. In your own words, you can look at your notes. You're muted.
Life settlement is a settlement that once you bought it, you can sell it anytime. Once you bought the policy, you can sell it, like what we were talking about, the vertical settlement. We say life settlement, you can sell your policy at any time.
Okay, and you can sell it at any time. And what is the name for the buyer of a life settlement?
The buyer of the buyer gonna be a policy owner.
Yes, yeah. When the buyer buys the life insurance, yeah, that person becomes the policy owner. But what's the name for people who buy life insurance? You know, like companies or individuals who buy life insurance from, you know, from policyholders.
Mhm.
Okay. The name for that is life settlement provider.
Oh, provider, sure. Life settlement.
And it's a vertical settlement. The people who buy vertical settlements were vertical settlement providers.
Sure.
All right, so we just covered 2 topics, and I know this was a lot of time, but on your exam, I mean, you have a lot of topics that you take. For example, here, you see here, this is the Nevada life insurance exam. Oh, wow, this thing keeps, you see right here, this is Nevada life insurance exam. So just Nevada alone, you have pretty close to 120 topics. And what we just covered is just 2 topics. So, and the same thing for Washington, D.C., you have about 105 topics. But what we just covered is just 2 out of that 105. No, it's third-party ownership and life settlements, right? So you see, the exam is a lot. And that's why we usually recommend to people to break it up. Don't do life and health. It's a lot of material. Break it up, do life first, study past your life insurance, and then go back, take your health insurance. And that's why we're so effective, because our students only do one. So our students do one, so you have a higher pass rate. So I'll stop here. Any last questions? Because we are done for the day. You guys were great students. I like the participation. Any questions, comments?
Excited.
How you're feeling about this? Are you feeling excited, Miss Asta? Do you think that you learned? You walk away?
Yeah.
With something?
Yeah, of course. I learned a lot of things. Yeah, very good. It's clear. I love to going again.
All right. And Leila, what about you?
Yeah, thank you so much, because the most difficult thing is the terminology. It is really hard. It confuses, because it's a lot of like what you say, life settlement, and so those things, it will help us a lot, for me especially. So thank you.
Okay, you're welcome. All right, so we're going to see you guys same time tomorrow, same link. And yeah, so thank you guys very much for attending, and I'll see you guys tomorrow. All right.
Yeah,
All right,
thank you.
thank
All
you.
right.
Take care, guys.
What time you
Thank you.
say? Let me write it before I forget.
The same
What,
time, it'll be 3 p.m.
3 p.m. Okay. All right. Thank you again. Thank you, everybody.
All right, guys. Take care.
Okay,
Thank you.
bye-bye.
Bye.
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 Good afternoon.